So we're getting ready to go here. I'm Gary Schnitke, University of Illinois. Today with us is David Klein, Soy Capital, and the leader of the Illinois Society of Professional Farm Managers and Rural Appraisers survey team, as well as Todd Keithy. And what we're going to do is the outlook for crop farm income, cash rents, farmland prices, and agricultural credit. Again, if you wanted to download our materials, they are available from our presentation website, and they will also be there after this webinar is over. What we're going to do here today is cover three broad topics. First is farm income, and I'll be covering that. Second, we will talk about cash rents and price outlook, farmland price outlook, so looking into the future, and what we'll be basing a lot of that on is a recently completed survey by the Illinois Society of Professional Farm Managers and Rural Appraisers. And then finally, Todd will talk about the implications for this for the agricultural credit market. So we're going to start here with farm income. Here's our farm income chart that goes from 1996 through 2016. This is the average for Illinois farms, grain farms enrolled in FBFM, again, 1996 to 2016. In 2016, the average farm size in this summary was about 1,500 acres, and it went from all over the state, from northern Illinois to southern Illinois. So 2016, you can see that we had about $90,000 of income in that year. For 2017, we're projecting that down, and something right now in the $50,000 to $60,000 per farm range. So down from last year. Major factor causing it to come down from last year is lower yields. Here is what USDA is projecting for the corn yield for U.S. corn yield, and this was their forecast as of August 10th. Their forecast was 169.5 bushels per acre. That surprised a lot of people as being pretty high. It is still 3 bushels above the trend, which was fit from 1972 through 2016 data. But still above the trend, near trend yield, but still for Illinois lower than we had last year. USDA projected our yields down in Illinois from down to 188 bushels. That, by the way, is still above trend, but last year in 2016, yields were for corn were 198 bushels, so 10 bushels lower for Illinois. Again, that was a bit of a surprise, but we're beginning to look at some of the yield estimates coming from different areas, it's a lot of those yield estimates support where USDA is coming out of that. Soy Capital just did one for McLean County, 198 bushels, I believe.
Yes, it was. Yeah.
So we're still above trend, but not as good as last year over the state. So taking 10 to 20 bushels off yield will obviously lower income. On soybeans, USDA came out with a USDA forecast of 49 bushels per acre on August 10th, and again, those will change as we're moving through time. Still above trend, both of those corn and soybean yields were down from a previous year. It's pretty safe to say that we're expecting both corn and soybean yields to be down in Illinois for 2017. So we have slower yields, and but prices have not rebounded accordingly. Here you're looking at market year average prices for 2006 through 2013 for corn. That was $470. We averaged $370 in 2014, $361 in 2015. 2016, so this is the marketing year, and this would be a national price. We're at $335. That's still a projection where we will be able to put that as a final at the end of the month when USDA releases it. It will be close to $335. USDA is projecting a price of $330 for 2017, and going out into 2018, looking at futures market, you would be saying something like $360. In that case, looking at 2017 first, you have lower yields, prices that are roughly the same according to USDA. If you're looking at fall bids in East Central Illinois, it's sort of still below $320 for corn, $905 yesterday. So those 2017 prices, we have to have some sort of price rebound to get to there. But right now, you would be saying prices the same as last year with lower yields, and obviously that's going to result in lower income. The other thing that we're looking at here is lower ARC payments for this coming year. This is for McLean County, and let me just discuss this a bit. Last year, or 2015, our payment for Ark County and McLean County was $54.39. That was received last fall. So that $54 was received this last fall. For 2016, which will be received this fall, can cut that down to $18, and there will not be a soybean payment. So we're looking at roughly, and this is pretty consistent across the state, half to lower on the ARC payments. 2017, there actually could be an ARC payment, and I put a 195 bushel yield in there, sort of keeping in with Soy Capital's forecast a little bit lower. 330 price would result in a $36 payment, and that would for 2017, which would be received in 2018. In any case, we have the case where revenue is going to be lower from crop revenue. Ark County payments are going to be down. And now I'm going to show you a typical professor slide that no one can see, and I know that. But if you download this, we have these for every county in Illinois, and they're by base acre. And as you can see there, we have corn payments from $0 to $60 per base acre. Again, these would be 2016 payments received in the fall of 2017 or this fall. Those are still preliminary because we don't have the market year average prices, and we also don't have the yields yet that FSA will use, so we're still using NASH yields. So corn payments can range from $0 to $60 with some of the higher ones in southern Illinois. Soybeans mostly near zero, and wheat payments from $0 to mid-zero, no, actually to mid-$30 per base acre. And again, download that slide if you want to and get your magnifying glass out and you can see them. We'll be releasing those later when we have the final estimates, but you can see you can expect less than last year, particularly if you're in northern and central Illinois. So we're going to have lower revenue. The good part of it is that we're going to have lower cost in 2017, and it does look like that will continue into 2018. 2018 costs will likely be lower than 2017 costs, particularly in the fertilizer area. We're seeing some good declines in fertilizer prices going into 2018. $400 anhydrous ammonia prices bid this fall, and again that would lower those anhydrous ammonia prices or fertilizer prices. So we're seeing that continue down, not as fast as our revenues going down. And here, just to give you a feel of what's happened in central Illinois corn, 2013 was our high non-line cost year. We had $615 a cost. 566 was what we projected for 2016, and this was all non-line cost. So those costs came down $49 after going up $313 from 2006 to 13. You can see here that our major decline has been fertilizer. It came down $39, and again, that's to 2016. We would be putting that something in the 130 range for 2017 and going down again to probably 110, 115 for 2017. That's our bright spot as far as cost, and that's been the one that's coming down. Some of these other costs have not changed as much. Cash rents have come down some, but most of these other costs have not come down as much. And the stubborn one that hasn't been coming down much is seed cost. Been roughly the same since 2013, and that was one of our major costs that haven't come down as much. So you're going to see revenue coming down, and again coming down in 2017 because of pretty close to average yields and no price response. So you have lower yields, lower price response. Seed non-land costs coming down, and then we're going to be again if we have that $60,000 of net income, we're going to have some tight economic cash flows. some tough decisions with lenders, and still some continued emphasis on cutting cost. This slide shows just operator and land returns, which is gross revenue minus non-land costs. So this blue bar would be for corn. The red bar here would be for soybeans. So this is gross revenue minus non-land cost, and then this green line here is for cash rent. Couple of points here again. So we had our good years from 2010, 11, 12, 13. Couple points here. Since 2014, we have had soybean operator and land returns higher than corn. I actually would expect that to continue in the future. As long as you have 370 corn, you have to have, if you're looking at 370 corn, you have to have something below $9 for soybeans to have those two crops having roughly the same income or gross returns. We might, again, this may be a longer lasting. We are seeing continued growth in soybean exports, particularly to China. If that market continues to grow, there will be emphasis on moving soybean or acres into soybeans, and that will be pulling some away from corn. You also note here that cash rents are above corn and soybean operator and land returns for 2017 and 2018. Again, what we will be looking at is, again, continued pressure on lowering cash flows, tight cash flow situation, and cash rents being above operator and land returns also suggests that we may be looking at other owned land and share rent land being the income generators on these farms, on those farms that have those income or those types of land rent. So again, lower incomes going into 2017, lower incomes. And right now for 2018, you would still be projecting lower incomes. You would be using lower incomes than in 2016, roughly $50,000 to $60,000 per acre. That would be based on, corn prices below $4, soybean prices in the low 9s and near average yields, and we can do that for a while. So that's our income situation for 2017. Repeat it in 2018, and that again will put some pressure on reducing cash flows. In that environment, we've just conducted, our Illinois Society and the University of Illinois conducted a mid-year survey, and Dave will be giving us some background on that mid-year survey.
Thanks, Gary. Appreciate that. And obviously, we always appreciate the coordination that you provide for our membership to be able to do this survey and put it together and help us coordinate the thoughts and results that come from it. So we perform the survey twice a year, once in the summer for mid-year, and then once in the January-February timeframe for year-end, after we feel like we've compiled the information that we need to have educated decisions for our membership to be able to respond to the survey. And so thanks so much to you and Todd for putting this together for us. The survey is based upon different land classes that we'll be talking about. And you will note in this map that there's kind of a darker green area and then a lighter green, kind of a burnt red, and then a more orange type coloring system. And that is reflective of generally the soil productivity indexes that are found in Bulletin 811 that's been produced by the University of Illinois several years ago. And so we try to match up to that, and we identify excellent productivity land as being if a field has greater than 133 soil PI average across all the acres in the tillable land on that farm, and then coordinating through the different land classes. So we'll refer back to those as we go through. And this is a survey of our membership once again, so it's not maybe exact data, but it's a good feeling of the people that are out in the trenches making the sales and making the cash rent decisions as they negotiate those with farmers on behalf of landowners. And so they have a pretty good pulse on what is actually happening out in the field, out in the countryside. Excellent farmland from our survey came in at $10,900 per acre. That is just slightly below the 10 or 11,100 I believe we were at a year ago. So it's down roughly 2% for the entire year, or 1.6% since we said 11,000 was the number at the beginning of the year. So a very small decrease, pretty much holding steady. That's probably within a margin of error that we would say is holding steady on excellent quality land. As we go down through this chart, though, the good and fair and average numbers, you start to see some drop off, and we do believe that's happening across the countryside on some of the less quality land or lower percentage tillable land where there is more non-tillable. Those are factors that come into play as buyers of farmland make decisions on how much they want to pay to purchase those different land classes. Good productivity land came in at $8,900 a year ago. At this time, that was roughly $9,400 an acre. So you can see basically a $500 an acre drop in the estimate from our membership year over year, from mid-year to mid-year. And then fair productivity land at $6,900 was a 3.8% drop from the beginning of the year. But as we look at that as compared to a year ago at this time, we were looking at $7,600 an acre, and that would be a little bit steeper drop. Average productivity land at $5,000 an acre, or a 4.4% drop since the beginning of the year. The volume of land that we've seen on the market for the first half of 2017 is very similar to 2016's last half. So that means the supply side to the market is pretty stable. Has not been overly burdensome that we haven't been able to get farmland marketed. So that is good news. That does a tight supply helps keep prices relatively stable also. If that continues, we would expect to see something of similar nature as we move forward. The farmers continue to be the major buyers of farmland. Our survey consistently shows 65 to 70%. And showed that again this year in our survey over the summer. There are some 1031 exchanges starting to occur again because the general economy seems to be maybe picking up just a tad as well. And as the general economy is stabilizing and expanding, that provides opportunities for people who are in the path of that progress to defer that capital gain tax by reinvesting in other farmland within a limited amount of time. And so those folks are making those exchanges. And when they do, that provides some additional buyer demand, which also helps stabilize the demand side. On the cash rent front, as we polled our membership, we saw very little change in their anticipation of where we plan to go with that. Part of that is a little bit reflective, I think, is we also asked a question about what we anticipate our corn price to be. And it was interesting to see that our membership actually had a little more bullish outlook on corn prices for the 2017-18 year when the poll was taken, which was late July, early August, than we were a year ago at this time when we knew we had a pretty good crop coming on. So that may be reflective of their thought process as well. But excellent quality land classes. In 2016, we had at $305 an acre and expect just a slight decrease there, maybe of $5 an acre. And the good and fair classes, also a 5 to 10 acre drop, averaging about $6 to $8 an acre, I believe, as we ran across the different land classes of potential pullback. A lot of this is reflective, though, of have your adjustments been made in previous years as well. And so as people are considering those different options, those are things that need to come into account as well. Most farm manager most farm managers expect their production costs in 2018 to be similar to that of 2017. And I will echo Gary's thoughts on the fertilizer prices, as we are doing some pre-pricing for inputs for this fall. We are seeing, especially as you mentioned, the anhydrous market, that nitrogen source is becoming the more favorable nitrogen source as compared to maybe past years where the liquid market was somewhat similar. There's definitely an advantage to using anhydrous possibly this fall and putting that on as a nitrogen source for your corn crop for 2018, and something worthy of checking into as we are seeing that across the state of Illinois as we check in with our different retailers. Most farm managers seem comfortable that variable cash rent leases are adjusting rents properly, and I will say we have a number of those where we set a base rent and then have an adjustment off of that. And many farm managers have incorporated those into their different leasing structures for landowners, especially those that possibly previously had crop share leases and want to be reflective of what is going on in the marketplace with net farm income in general. There's different land classes that we have, and you can see the different regions across the state, and those more accurately define different areas, especially in our March Outlook meeting, which we are looking forward to having Dr. David Cole come and speak at this coming March. So look for that to be coming out, and the release of the land values booklet at our website, ispfmra.org. And so that's my portion, I believe, of the presentation.
So, and we had one question here, and that is, what is considered professionally managed farmland, and what professionally, and Dave can step in here at any point in time, but in the Midwest there are individuals, professional farm managers that represent the landowner and aid them and do a lot of the work in making the decisions on rental type, cash rent arrangement, monitoring of the farm, and they do that for a fee.
We do, and that whole profession was really started right here at the University of Illinois in 1929, I believe, and
we weren't here.
No, none of us were here, but the basis of that occupation started as a result of the Depression and the need for professional management of farmland to help folks get out of their economic situation and make proper decisions.
It's pretty safe to say, not on the professional managed land, that the farmland prices probably have followed a little bit different path than farm incomes have. Farm incomes have come down, whereas farmland prices has been stable,
a little more stable, and that's reflective, I think, a lot of the fact that land is a unique animal. It's highly dependent upon farm income, but not totally dependent upon farm income, and we are seeing an expansion of different energy sources, whether it be wind or solar, and those discussions, and that comes into play, and also as folks look at where the stock market may be at and how it has made a pretty good run up at this point. And so some folks are starting to take some money off the table from the stock market and looking at what the alternatives are and like do like farmland as a portfolio diversifier, and it is an excellent portfolio diversifier for those folks, and as we have found over time. And those absentee land owners provide capital when we need it, and sometimes we need it when maybe our farm incomes aren't as high and the farmers aren't able to pick up all the slack that is in the supply of the market. So it's working correctly, I guess, is what I'm saying. And Illinois is a good state to do business in from a ownership standpoint. They welcome all people to own farmland here, and they're not prohibitive at all. And so as a result, that helps bring all kinds of things to the stabilization of our land values.
There's another question we'll ask before we get to Todd here. What do you see for 2018 rents compared to 2017? We would say down. Professionally managed land's down slightly. Average, so professionally managed land have typically been higher cash rents than average. So if we're looking at $300 for excellent quality land, the average is probably at $280, $275, somewhere in that range. Average, I would expect to come down as well. The question,
which is where you start from to begin with. Yeah. And if you've already made some of those adjustments, maybe you need to tweak it a little more. But we also know that if you haven't made adjustments, then it may be time to be making adjustments with your farm operator based upon what we see is negative earnings potentially being.
So we're going to move on to Todd here.
Okay, thank you. So I'm going to give just a brief overview of where the agricultural credit market sort of sits based on some data that we have. And looking mostly at the short-term market, so I'm not going to talk about farm mortgages specifically. There's some evidence that the credit market is strengthening a bit. We're seeing, and I'll go through some examples of from data that show that demand is coming down a little bit, and we're seeing a little bit less in terms of repayment issues. But the short-term agricultural interest rates have increased slightly this year as the Fed changes their policy that works its way through most short-term interest rates by way of adjusting the prime rate. And then I'll talk a little bit at the end that shows that we're expecting sort of further increases in interest rates going forward, which could mean increase in interest expenses. So the data I'm going to talk about actually comes from surveys conducted by the Federal Reserve. And Illinois is served by 2 Federal Reserve districts. The basic northern sort of 2/3, northern half is part of the Chicago Fed district, which you can see includes all of Iowa, Indiana, and then also the southern portions of the northern portion of Indiana and the southern portions of Wisconsin and Michigan. So it's pretty representative. That survey does a pretty good job of tracking the Illinois portion, where the southern Illinois portion is in the St. Louis Fed, which includes a lot of the sort of the upper delta in terms of Arkansas, Western Tennessee, Mississippi, Kentucky. So it maybe isn't quite as representative of those farms in that area, but it's still relatively representative. But I always want to kind of stress that these surveys talk about broader than just Illinois. And so both Federal Reserve banks do. The Chicago Fed has a very long history of doing this, and St. Louis started their survey in 2012, I believe it was, is they survey different bankers in their region that work at agricultural banks. So meaning that they have a sizable portion of their loans directly to farmers, their portfolio, and they ask them various questions about the credit market conditions and questions about their outlook for farmland values or the ag economy more broadly. And they also ask about what sort of interest rates they're charging, what kind of standards they have on their loans. And so they ask, sort of in the last, what's changed at your bank? Specifically, we're looking at the non-real estate farm loans portion of it. What's changed in the last 3 years relative to a year earlier? So they're a little bit subjective. And they also, we don't want to burden busy people to fill out surveys, as Dave and Gary both know. So we have to ask very short questions, right? So they say, are things higher, lower, or the same compared to last year? So we're going to look at the demand for loans, the rate of loan repayments, and then also renewals and extensions. So how many people are coming into sort of renegotiating their financing? And I use a really simple index to look at these numbers where I just subtract the lower from the higher. So these are sort of net positives or net higher. And so these are the people that think, for example, the demand for loans is going up compared to a year earlier, or repayment issues are higher than they were a year ago. And so we'll start here. This is the Chicago Fed part for the credit conditions. And this is the loan demand. And you can see since 2014, the bankers consistently think that farmers are coming in to demand more loans than they were a year previously, although that's starting to come down, right? So when we're looking at these numbers coming into 2017, so this is through the last 2 bars that I represent this year. It's through the first 2 quarters, or essentially the first half of 2017. We can see that there's still elevated credit demand, but it's not continuing to sort of spike up. We're starting to hopefully see sort of a reduction in demand. Now, obviously, borrowers our lenders love to have demand for the loans. They like to have a strong demand out there. But as economists, we worry about when that demand exceeds, the available supply, and we end up with a credit shortage, which is an issue that you've heard a lot of concerns about around the country. But we haven't had it quite as much here as we have in other areas of agriculture. And so then if we look at the repayment rate, now this number we actually like to be the other way, right? So now we have more bankers saying that, because this number is negative, meaning more bankers are saying that the repayment rate is lower than it was a year ago, meaning that they're having more challenges with farmers being able to pay their loans, so we don't like when this number is negative. And it's still negative, but it is sort of trending upward since 2016. So we're hopefully starting to see kind of a rebalance. We're not going to see, sort of problems with defaults or repayment issues. And then the last piece here is the renewals and extensions. So this is people that are coming in to refinance their loan or renegotiate the terms, maybe if they're dealing with sort of a medium-term credit, to extend the life of that loan to lower their payments or debt obligations in a quarterly or monthly fashion. And so, again, that number is positive, which is not what we'd like to see. So saying bankers are seeing more people wanting to renew or extend their loans. But that number is sort of coming down. So although it's still kind of a tight credit market in terms of loan demand is high, because farmers are wanting to, maybe offset some of their loss in working capital by borrowing to cover short-term needs. But the signals that bankers think about when they ask what's going to be the risk premium or what are they going to charge on interest or other criteria to evaluate loans, they look at what's the potential for successful repayment. So although those numbers are still on the opposite side of the axis than we'd like to see them, they're starting to come down, that's why I say hopefully signs that we're seeing a strengthening in the credit. And this is the St. Louis Federal Survey, which started in 2012. So the graph isn't quite as pretty, so this would be sort of the southern portion of the state. Again, keeping in mind that it's wrapped in a lot of the Delta states. But again, you see the same phenomenon of elevated loan demand and also elevated use of renewals and extensions, and repayment rates lower. These numbers don't seem to have quite as strong of a trend back towards that zero line like we'd like, but they're still sort of at more comfortable levels. And then the last little part here is I wanted to show you that this is the fixed interest rate for operating loans published by both Chicago and St. Louis surveys. We can see that they've held relatively constant. So people keep concerned about raising interest rates and how that's going to affect the cost of borrowing. But those interest rate increases the Fed have been doing have been very small and at a pretty slow pace. And so the prime rates haven't really jumped up drastically. And the other factors that go into causing the agricultural interest rates, so the risk of repayment from the lender's perspective, have held relatively stable. So we start to see a little bit of an uptick. It's kind of hard at this scale to see. But that St. Louis line has a little bit of a smile to it. The interest rates are coming up higher like they were sort of in 2012. But still, just long run has been trending down. We're still at a position where we have historically low interest rates, which brings me to my last part. So this is from the Federal Reserve's Open Market Committee, who sets the discount rate for the Federal Reserve. So this is the rate at which banks are charged when they put in overnight deposits, and that becomes basically the lowest risk short-term interest rate, and that's sort of the base rate that everything sort of on the short end of the yield curve gets ratcheted towards. So this committee meets several times a year to outline what they think they should do in terms of policy, and then they vote, well, what do you think that discount rate should be? And then they publish these with a little bit of a lag because they don't want to have too strong of an influence in the market. So the most recent that we're able to get is in June 2007. So each one of those blue dots represents what some Federal Reserve manager, so either a governor or a bank president, views what they think the interest rate should be in the economy. And the two big clusters that are interesting to look at are 2017. So everyone agrees that they should be low, sort of around the 1.5 area, 1 to 1.5. So we need to have low interest rates right now. If you look at the longer run, they all agree sort of the long run steady state is closer to 3, and interest rate a lot higher. And so we have two pretty tight packs of clusters where that group of economists they agree. But if you look at what the idea is for 2018, 2019, or basically how do we get from now to the long run, there's quite a disagreement, right? So some people are very aggressive, wanting to raise rates drastically. We've got at least one member wanting to vote to keep them essentially constant throughout. We have in the past there have been voting members that have argued for negative rates as well. And so there's a real disagreement. So what is the path we're going to get there? Which, as an economist, this gives a signal that we expect to see rates continue to increase, but we're really unsure of sort of what speed or when or how that's going to kick in. From a farm perspective, that does mean that we could expect to see continued increases in short-term borrowing rates as the interest rate increases. A part of that will get passed through to borrowing, so we would see higher interest expenses. But I don't think we're in enough agreement to be able to sort of bank on that occurring right now. And at least it appears that there's enough members that are arguing for a slow, moderate pace to that interest rate increase that I don't think we're going to see sort of a situation like we had in the early 1980s where we have drastic increases in interest rates sort of overnight.
So I'm curious here. So if we did reach a 3% long-run short-term rate, what would that mean for a farm short-term farm borrowing or operating note? Would that be 4% for operating note or?
Yeah. So that's a good question. I should work through them. That'd be a good thing to work through, Gary. So the way this 3% rate is basically what the bank is allowed to borrow and save overnight, and so that's kind of what they would charge each other. And then so they establish what they call the prime rate, which is their best lender. So the people that you basically are guaranteed will repay on short-term loans, or as close as a guarantee as you can get, and they tend to mark up from the discount rate. Recently, it's been sort of about a 3% increase, which would actually put it closer to 6%, what they would be borrowing. And then the ag interest rate is usually above that because there's some borrowing premium. Even our best borrowers are still dealing with agricultural production, right? So that would say it would actually be closer maybe to like a 7%. If that holds, I'd want to look through. I would think actually that gap between the prime and the discount rate would hopefully narrow in a little bit. So we would be thinking more of agricultural rates kind of in the 4 to 5. But
yeah, so. But that's the long run, and we've been looking for that for a while, right?
Yeah, it seems like the long run is always out there. Eventually, we haven't gotten to it. So maybe I'll work here long enough that I'll be able to tell you we're at the long run.
All right, so we've actually have completed our presentation, and if you have any questions, enter those, and we do have a couple here, and so we'll go through those and answer them as we're looking through that. One of the first ones is why have seed costs tripled from 2004 and they're not falling like other costs? And that's a very good question.
Do you want me to work on that one?
Go ahead, Dave.
Well, one of the things that I believe are incorporated in seed cost increases not only are the genetic increases that our production is just more stable and higher, but through genetic improvement. If you look at for instance, even the 1988 drought as compared to the 2012 drought, while we had some terrible corn yields, we certainly were able to hold out longer than we were in 1988 and have better production. I've lived through both and observed both extensively, and so just in that alone, we've improved things over time. But the other thing is we are putting on more seed treatments, and I think part of what is reflective of even this year's, roughly $4 an acre increase is there's going to be on a lot of seed corn production, particularly nematicide being put on, and so that alone is going to add that $3 to $4 an acre. And because so many seed companies are trying to protect their production as compared to others, it's just going to be put on automatically almost, and you're really not going to have a choice with some of the more elite hybrids. So if you want to plant the more elite hybrids, you've got to take the seed treatment that goes with it, and that additional cost goes along with it as well. So that's a component of it. I know seed companies really try to, and we as farm managers even are trying to sort through the different potential fungicides, insecticides, seed treatments, and foliar treatments, and trying to make decisions on what to do and which ones to do and which ones not to do. But that's maybe in a nutshell, part of it is seed treatments and improved genetics.
I would also mention that we have 6 companies merging down to 3, and less competition there as well. And there is, it isn't a commodity. The good seed, you need good seed to produce good crops.
Right, and the difference between seed and fertilizer, for instance, fertilizer is a commodity, and for the most part, and we can certainly have some different blends made or some different things added to certain fertilizers, but for the most part, there's a distinct difference between those two, and that's part of what's going on there.
So we have another question at 305. So, all right, what is the average base rent for a variable cash rent? I would point out that the cash rents that we've been looking at are straight cash rents.
Correct.
And so when we're looking at a base cash rent, and I'm assuming here, and Dave will jump in here in a minute, but a base rent would be, if you have a variable rent, you're going to have a base rent in it below which the rent cannot go. And then you'll have a higher than that level if, for example, gross revenue is above a level, or you take gross revenue times a percentage.
Right. So the ones I work with professionally on professionally managed farms, that's what we do. Now, it doesn't mean that, especially farm families and farmers with certain landowners, if you've been in a crop share arrangement in the past and your goals and objectives as a landowner is to just kind of reduce some of the paperwork but end up in a similar format that you can't go up and down. That's your prerogative of how you want to work that out between a landowner and a farm operator. But it really comes down to goals and objectives where you start out at. Mm-hmm. And there's certain levels with certain landowners that they just do not want to go below, but they're willing to lower their rent in lieu of having that upside potential and coming back if things from a economic standpoint work out positively. And so things that go into those factors are not only yields, prices, but sometimes the government payments and things of that nature.
Yep. So, and by the way, just as a commercial here, variable cash rents are a very good idea. In my opinion, they put some variability in that and put some more risk on the landowner, which is not good from the landowner's perspective, but allows that variability there. My observation is that most people go to cash rent because they like the simplicity, and most of our variable cash rents are used by professional farm managers. So that's just some of the observations that I see. We have a question on our 2016 ARC County payments. Do they reflect the 85% payment rate and sequestration reduction? And if you can say that fast 3 times, you're doing good this morning. These payments do reflect if you have a base acre of corn, it reflects that 85% reduction. So if you have a base acre in, say, Alexander County, you will expect a $53 payment. That's after the 85% reduction, and we did put a sequestration amount in there. Other question here is why our multiple Illinois counties have NA. Here's what, and these, and again, I want to stress that these are still estimates, and what we are using is NAS yields to make those estimates. So those yields come. NAS, National Agricultural Statistical Service, released yields in February, late February, for counties across the nation, but Illinois in specific. If we had a yield for a county, we estimated it. If you see a NA in this table, it's because NAS did not release a county yield. So if you see an NA, we didn't feel like we had any basis to really make a county yield or a county yield estimate for that county. So if you see an NA, that's why that is there. By the way, FSA does determine their own yields, and typically, if anything, they are lower than NAS yields. Do you know what will determine what yield levels will ultimately be used to determine payments and when those will be determined? So when will the FSA release their yields? And they will release that. They could release that from now. September to early October is when they will release those yields. And typically we'll see our county payments being made after October 1, September 31st, October 1. FSA will release their yields. They use, when NAS data is available, they use that plus some failed acre information from RMA. And they will determine that, and they will release that. And then after we know that, and the final market year average price, we will be able to make those payments estimates. So what is the standard rate per acre charge for professional farm managers? That will vary outside of that one.
Yeah, if you have interest in that, I would just refer you to the Illinois Society of Professional Farm Managers and Real Appraisers website and contact a farm manager in the area of your farmland and ask them directly. And if you're interested in professional farm management, that's ispfmra.org. ispfmra.org.
You see the website listed there. I would also so the survey that Dave went over today, there's more information there as well. There's a press release as well as a longer write-up on that. Does the 2016 ARC County payments reflect the 85% payment rate and sequestration rate? Yes, they do. How accurate were your ARC County payments projections last year? Well, so they're very good, given that you know what the price and the yield are. How about that? No, actually, at this point in time, those ARC County payments will be pretty close because we do the ones we're putting up there today. The market year average price, we used a $3.35 price for corn. It's not going to vary too much from that. If anything, the yields that will be used in those payments will be lower than the ones we're using. So if anything, those price payments could be up.
I would say if you used our McLean County yield last year, we were within 1 bushel of the McLean County yield on our estimate. So we were very fortunate to be close last year. I don't know if we'll have that same accuracy this year, but that's a good indicator.
Yeah. One comment. I wonder about the 2% reduction in pesticides given the emergence of herbicide resistance and more frequent and expensive herbicides. And that's a very good observation. Over time, we do expect pesticide costs to increase as we have more herbicide-resistant problems. One thing that I would note, though, is that our pesticide costs will vary from year to year, just simply be depending on pest pressures. And, if we have a sort of a outbreak of a fungus when we had to make more fungicide use later in the year, that could be that could be part of that. So if we've had a lot of spot spraying and problems throughout the year, which are pretty difficult to anticipate, those could go up or down. So they will vary some from year to year. Do you have some prediction about corn and soybean yield on 12/9 report of USDA? So you would everybody's looking at me like going, who wants to answer that? Right?
That's outside of my.
I was going to say that's another Todd.
That's a Todd Hubbs question.
Google the name Todd Hubbs.
Yeah.
Todd Hubbs, and he will answer that question. I think he's actually saying that he expects them to be coming down.
Just a little bit, yeah.
Coming down.
Maybe a couple bushel per acre.
Yep. Has there been research on supply elasticity of farmland demand? How much of the stable land price is smaller supply? So,
What professor asked that question? That's a great question.
so actually, that's a good question. Unfortunately, measuring supply and demand in the farmland market is very difficult because the supply is so low. There's such a low turnover rate in any given year. It's hard to.
Yeah, it's about 2% of all farmland that actually changes hands, but that's just a change of ownership. Usually about 1.5% is actually what is available on the market for all of us to have an opportunity for it.
Yep.
And so about 25% of all farmland that changes hands is actually just changing around within related parties or something. And so most research assumes a relatively inelastic supply. In fact, most of the people that sell farmland nationwide, it's to do things like settle an estate so it's not. There's very little sort of traditional market dynamics where you see prices are high. If you own something, you're like, well, maybe this would be a good time to sell it. We see a little bit less of that in farmland. Supply and demand do move around a little bit, I think, in price response, but it's not. It's not like a market for baseball cards or something where you see supply and demand shifts around quite a bit. And so really it's just sort of a matter of demand elasticity, and even then it's such a small rate. And also the not only is it small, it's periodic. So it's kind of there's times of the year where we have a cluster of sales, so we aren't able to sort of it's a lot harder to estimate. But so we sort of assume supply is inelastic, and then demand is a function of the characteristics of the land, and also a little bit with the characteristics of who's selling it and buying it at the time.
So, do you believe land prices will stabilize or continue to fall over the next year or two based upon the prices of the earlier slide? So land prices, and Dave and Todd will jump in here at any minute, but land prices have been coming down. They've been coming down. I would almost call them stabilized right now. It's been sort of at this plateau. They've been edging down a bit, but really fairly stable. Looking forward, you don't really see anything that's going to say we're going to have a massive decline in farmland prices, unless you would see interest rates increase substantially, which I don't know. I mean, they keep talking about getting to this long-run interest rate, and they haven't done that.
We haven't had so the drastic jump we had in interest rates of the 80s, which are sort of that's the part that a lot of farmers go back to. But if you look historically at U.S. federal policy, that's actually the anomaly. It's not like we expect to get back to that at some point. We were fighting all kinds of currency issues with inflation and stagflation and all kinds of weird things coming out of the 70s, and they realized that the best way to combat that under the Volcker administration was the Fed was to just raise interest rates quite drastically. So I don't think we would – I would be very surprised to see that happen again. I think something in the neighborhood of a 1 or 2% change in farmland prices for the next several years. And I would not be surprised to see that be 1 to 2% positive. I wouldn't be surprised to see 1 to 2% negative. I think kind of fluctuating kind of around where we're at. We know that farmland traditionally grows just a little bit ahead of inflation, but inflation's like super low. That's the big puzzle right now, right? So that we don't see that sort of inflationary pressure that would actually be good for farmland. So what we wanted to have is inflation to be high enough that we have upward pressure on the farmland, but not inflation so high that we drastically jack up the interest rate, which hurts productive assets.
That's always the good question. The other thing that could happen is that, for example, cash rents fall significantly. That would put some downward pressure on farmland prices. again, we're still seeing probably stable to down cash rents. I'm one of the. Let me go to here. I just put corn yields in the United States here. We have been running over on corn yields below, or excuse me, corn prices below $4 since 2013 forward. Mm-hmm. And if we get to $4 corn, everything sort of stabilizes and everything becomes good. And as long as we're scraping here at $3.40, $3.50, $3.60, it's going to be a tight economic environment.
I would even echo that if there's a chance to sell $4 corn and farmers sell it, it seems like we're okay.
Yeah. But to get there, we probably have to see something like a yield decline
on some hemisphere, one or the other.
Some hemisphere.
Yeah, north or south. Yeah.
Yeah, and if you look at U.S. corn yields, since this is 2012, we had our price decline here. 2013 was at trend, and then we've been above trend since then. And, one of the surprises, I guess, was that this year was still above trend, or at least a good yield.
Yeah, I think that surprised everybody once we started checking fields.
So if we ever get to the point where and where we're below $4 for a continuing time, you could see those cash rents come down quick, I suppose. If we get to pretty much lower prices than we're at right now.
Yeah, sustained lower price. I mean, it's just like I said, once again, I think if guys can get that opportunity to sell some $4 corn and sell it out in the future, they'll lock that in, and that helps stabilize where those rents can be at too. So,
is there a website to track the market year average price for ARC payments where we get? So those are the place where we get those estimates are the WASDE report. It comes out every month. World Agricultural Supply and Demand Estimate Report. If you have a search engine, type in WASDE to get the current report. And you'll see tables in there for corn, soybeans, wheat, and a whole bunch of other tables in there. But if you go to the U.S. domestic side, they'll give you a range of the price for the past or the upcoming year. And that's actually what we use in these payments. What do you expect crop insurance payments to be? I expect, that's another. They're going to be higher than last year. I mean, and we're going to see, we're going to see quite a few in that droughty area in central Illinois. There will be some farms that have it. In southwestern Illinois and spread around the state. Overall, if you're looking at if a farm's getting a crop insurance payment, they're having a bad year this year because they have a low yield and low price.
Right.
Do professional farm management companies also manage sales of land for landowners? And the answer is yes, right?
Yeah. So certain ones do, certain ones do not. Some farm managers just manage farmland only. Some farm managers appraise farmland. Some do not and have state certifications to do that. So Soy Capital we do, and some others do as well. But from a standpoint of, once again, maybe look at that Illinois Society of Professional Farm Managers website, or our Illinois Realtors Land Institute website, which is another good site to look at, Realtors Land Institute of Illinois.
Is it wise to allow cash rent split to March 1 and October 1? So this is a cash rent question, and there's several different ways that times you can have the cash rents. Two of the fairly common ones would be have it split March 1 and October 1. Another one would have it all up front March 1. And those dates are negotiable. Right?
Those dates are always negotiable. Part of it's your goals and objectives as a landowner and what you're able to work out with your tenant. Obviously, a split date helps the tenant with his cash flow, so he doesn't have to borrow quite so much maybe for an operating loan. So that can be beneficial to him, maybe even give you maybe a little bit more rent because he's not having to pay it in interest. But from a standpoint of the March 1 date, from a safety standpoint, you collect it all up front. You've got it that way you don't have to worry about not getting it later if something bad would happen. So it all depends on where your goals and objectives are at, and you need to think through those things possibly as you enter your lease negotiations going forward.
I would also say that we've been seeing more rents move to one payment in the spring, and a low interest rate environment makes that not.
Yeah, with the interest rates where they're at, it's not quite as big a deal as what it used to be.
Yeah.
And it used to be a big deal when you were paying 10, 8, 9, 10% interest as an operating loan. So
we have come to close to the bewitching hour of 9 a.m. We appreciate your time here today. Just to summarize here, we would expect incomes to be down, cash rents to be stable to down, farmland prices to be stable to down, and agricultural credit markets to be tighter. Tighter.
Have your statements in order.
Yeah.
Make sure you can communicate well with your lender.
And we appreciate your time tomorrow. We'll root on the Illinois at their football game tomorrow.
Yeah.
And thank you for being with us today.